Hey guys, welcome. We're going to get started here in just a few minutes. Hope that's cool. I'll talk to you in a few.
Work me out for another apple. They're about to get right in the big.
Hey guys, we'll wait a few more minutes here and then we'll get started.
Hey, Ken.
Who says that? Hey Lawrence, how's it going, my friend?
Good, man.
Awesome.
Doing well. I'm in Las Vegas at a trade show right now, so.
Oh, are you?
Outside. Yeah.
I'm gonna be in Vegas in about a month or so.
Okay. Yeah.
We're doing the money show.
Oh, okay. Yeah. That's good. I'm at the conference center, but we're at what they call Con Expo. It's all big construction equipment.
Very cool.
So it's good stuff.
Very cool.
Spent a couple of days snowboarding in Utah before I came out here, so that was fun.
Good for you. Good for you. All right. So we'll give it another minute or two. Yeah. So hopefully, I bet it's nice and warm there, right? Lawrence, you're warming it up for me when I get there.
It's beautiful. Look at that.
I know. Very nice. You're killing me.
Weather's beautiful.
Yeah. Good for you. And you got your famous conference lanyard on. I like that.
Oh, yeah.
Yeah. I love it. All right, guys, we'll get started here. Lawrence, I'm going to mute you if you don't mind. Hopefully that's cool. If I can find you.
Already done.
Oh, you're this. All right. Thanks, man. All right. Everybody, welcome. Hey, so while everybody's still filing in, for some of you who may or may not be used to Zoom, a couple of things. One, if you have some comments that you want to make, please do me a favor and use the chat. All right. In the low, should be, if you're on your computer, right along the ribbon on the bottom, you should see a little button that says chat. If you click on it, it'll open up a window. You can type in that little window. Max is here with me. Max, where are you at, my friend?
I'm here.
There you are. Okay, good. So Max is here. Max is going to man the chat for me and try to keep me out of trouble so I don't do anything crazy. So thanks, Max. And then if you want to raise your hand, all right, my goal is to make this thing participative. That's a word. You don't want to hear me just talk to you. I want to have some back and forth here. In order to get our attention, the easiest way to do it is in that same ribbon on the bottom. There's a little button that says reactions and then raise hand. That puts you at the very top of the gallery if you're in gallery view. And then I know that you wanna say something and we can get you involved. So please do that. Hey, so could you guys do me a favor? I see some new people here that I don't recognize, and I do see a lot of people I do recognize. Can you tell me where you're at in the chat, just to kind of get people used to using the chat? Where you at? What city, what state, whatever works for you. I'm always super excited. Philly, yep. Thanks, Brandy. I'm always super excited to see where everybody comes from. Phoenix, good Lord, we're everywhere. Miami, Phoenix. Where else do we have? San Jose, California. All right, where else we got? Washington, Orlando. A lot of good weather states. I like that.
Yeah.
Denver. All right. Warren, I was going to say, Warren, Northern Virginia. Wow, that's super impressive. I'm so excited to have everybody here. So thank you for that. Now, as you know, we always wait a minute. There we go. The Hawks here. All right. That's awesome. All right. So one of the things that I always want to try to recognize is if there's any investors in our room. I happen to know there are some of our investors in this call. If you have any interest in raising your hand as an investor and making yourself known to the other people in this room, I know a lot of times people, when they talk to us about investing with us, they love to talk to investors. They want to hear what's your experience like, how's it going, is Ken really a decent guy, you know, what is it like to work with KRI? And a lot of times they like to have those private conversations. I don't give out any of our investors' names because I respect your privacy, but I would love to have you guys have the opportunity to communicate with one of our investors. If you want, we leave the chat open so you can have those private conversations. I don't even think I can see those conversations, so they're super private, and that's awesome. So if you would, I can see at least 5 to 7 investors here that are with us. So if you want to make yourself known, great. If not, that's okay. All right. So hopefully you know me. My name's Ken Gee. I'm the founder here at KRI Partners. And a little bit about myself for some of the people that don't know me very well. I grew up in a little bitty town called Toledo, Ohio. We got my undergrad from the University of Toledo, and then got my graduate degree. I moved to Cleveland, worked for a bank for 5 years as a commercial lender. Went to school at night at a small private school called Case Western Reserve University. Pursued my master's there. After I got my master's, I decided I wanted to be an accountant. So that's what I got my master's in. And so I moved to Deloitte, one of the big accounting firms on the tax side, spent 7 years there. Got to do a lot of really, well, to the extent you can have exciting accounting work. It was, as accounting goes, very exciting to be able to do a lot of M&A work. I worked with a ton of private equity firms that are common. I mean, they're household names. You would know them. I got to do a lot of transaction due diligence, a lot of transaction structure planning. It was really exciting. A lot of what I learned there, I bring to what we do today. But it was there that I really got my start in real estate when I was there. I'll try to keep the story brief, but you know, it's interesting. I was really young. It was 25 plus years ago. My daughter was very young. It was in the middle of the night. I was feeding her, doing her night feeding. Why was I doing her night feeding? Because that was the only time I got to see her, because I was working so hard as a CPA at Deloitte. If you know anything about CPAs, man, they work hard. So that was my quality time with her, and I loved it. It was really cool because it was just her and I. And if any of the fathers here have a daughter, you know exactly what I mean. There's nothing like a father-daughter bond. So, but what happened is all of a sudden one night I started to realize that, wait a minute, man, this is my quality time with my beautiful daughter. It's at 3 a.m. and everybody's asleep. I started thinking, how am I going to put these kids through school? How am I going to do this without racking up a ton of debt? How am I going to get to take some time to spend with them? How am I going to be able to see her basketball games? I mean, the best I can do is feed her at 3 a.m. That's not cool. And I didn't want that life. So I said, all right, I got to figure this out. So I embarked on the next year and a half journey, spent a lot of time, a lot of money trying to figure it out. There was not nearly the amount of information available back then that is available now. And so I took a couple of years and figured out this real estate thing. I bought, as it turned out, over a 3-year period, I bought 3 small buildings, all less than 30 units each in Cleveland. And 3 years later, after I bought the first one, I actually sold all 3. And the next thing that happened just blew my mind. So I was working at Deloitte, and on the side in real estate, I had sold those buildings and made $500,000. It was just mind blowing, because here I was on the side making $500,000, probably more than what I had made the whole time I had been at Deloitte. And I did this on the side. So I thought, you know what, this is awesome. I just figured out how I'm going to put my kids through school without a ton of debt. How am I going to make it so that I can potentially take charge of my life and stop working so hard for somebody else? So continue fast forward now 25 years. I'm thrilled to tell you I did put my kids through school without any debt. We have done, as I'll tell you later, 18 deals, many millions of dollars worth of transactions. And we have helped hundreds of investors do the exact same thing that I've been able to do. So I'm super excited about that. So that's a little bit about my background. Tonight, this is our Real Deal webinar. We're going to do these each month. Boy, there's a lot of crazy stuff going on right now. Let me tell you, I thought, well, maybe I'll do this presentation a couple days in advance. Man, not in this environment. I had to do this a couple minutes in advance because there's just so much going on. So let me share my screen here before I forget, and Max has to remind me. All right. So bear with me here. All right, I got to read my disclaimer just so that everybody's clear on what we can and can't do. Please note that investing in real estate and other financial instruments involves a high degree of risk and the potential loss of some or all of your principal. This presentation is not an offer to buy or sell or solicitation of an offer to buy or sell any interest, securities, or to otherwise participate in any investment or trading strategy. Any such offer can only be made through definitive legal documents, including an operating agreement, private placement memorandum, and other important subscription documents, which includes important information about risk, loss, and other risk factors. Please note that nothing that I'm going to say here tonight should be construed as investment advice, tax advice, financial advice, legal advice, anything like that. Before making an investment decision, please make sure that you consult your own financial advisor. All right, so now that we got through that, when I sent out the email, I decided there was 4 things I wanted to talk about tonight. The 4 things include, number 1, why higher cap rates and interest rates continue to be a good thing for investors, for you as an investor. That's a continuation of last month's topic. Why deal flow has picked up, and it's actually picked up quite a bit. Why many sponsors have stopped distributions. If many of you are invested with other sponsors, you may have gotten that email that says that they've stopped distributions, and why at this point we have not. And then, should you invest now or wait? That's the question everybody always wants to know, because it's just, there's so much going on now. You gotta try to make a good decision. Now, on last month's call, I spent some time just reminding everyone about why we make money in real estate. I'm not going to do that again. But what I want to do, and this is the reason I'm talking about this here tonight, is because right now, more than ever, experience matters, right? To navigate these crazy things that are going on. Some time ago, I kind of put together 4 rules that I talk about a lot, but it's 4 rules to help you vet investment firms. And I'm going to talk about these 4 rules here. First one's experience, track record. Third, investors first, and transparency. Let's talk about these a little bit each one by one. First of all, number 1, make sure that whoever you invest with, either it's us or anybody else, make sure that they have some experience. They have to have experience. And it's not, everybody tells you, yeah, experience matters, but it's the why part of it that really should hit home for you here. All right. The why part of this whole process is, we don't know what's coming next. You want to make sure that the senior management team that's running this business, that happens to be an apartment complex, that they can navigate whatever's coming around the corner. I always tell people, look, we didn't know the pandemic was coming. We didn't know that 8-10% inflation was coming. And you need somebody at the helm that can try to, that can figure out how to navigate these things, because we just don't know what's coming next. Hopefully, with enough experience, they've managed through multiple real estate cycles. And of course, I should tell you, I mean, we've done, we've got a great deal of experience. Our management team's managed over 16,000 units over the last 25 years. The bottom line here is just don't let someone else learn on your dime, right? Now more than ever, please don't do that. It is not going to be helpful. Rule number two, they have to have a long track record. This kind of goes without saying, but you want to know that they've done it before, and not just that they've been able to buy deals. Anybody can buy a deal. It's different to be able to take that deal full cycle and do really well for their investors. So we've done 18 deals, more than 125 million bucks. And I'll show you a few deals tonight that we've earned 20, 25, even 30% plus annual returns. So we are, we think our track record is really important, and it gives you some clear visibility. But the reality of it is I can write anything down on paper. It's really hard for you to verify that. So we went out and we hired Veravest, paid them a ridiculous amount of money to go through our deals and look at settlement statements and tax returns and all kinds of stuff, all 25 years worth of deals. And we asked them to verify our returns to make sure that what we were saying was true. So I'm proud to say that our entire track record is on their site, and if you just click that QR code, you can get a look at it. Rule number 3, you want to make sure that whoever you're working with is going to put you first. That's extremely important. Problem is, it's harder to figure that out, and so the only way to do it is to take a look at the PPM, take a look at their operating agreement, see what their fee structure is like, see what the terms of the investment is like. There's nothing else you can do. The only thing I can tell you is, number one, you're looking for profit bonus. I believe profit bonus should be performance-based. That in our world, we call that the carry interest, and I believe it should be paid last, right? So we'll talk about our fund and how we structure this to achieve this goal. But if you ask yourself, as you're reading through the PPM and the terms of the deal you're looking at, is it possible for the investment firm to do really well and you not do well? Okay, if that's possible, then you need to really kind of dive in there and figure that out, because that means they're not really putting you first. And I just don't think that's the right thing for them to do. Last rule, make sure that they're transparent. We do quarterly updates. Those quarterly updates include financials, which includes a profit and loss statement, a balance sheet, a rent roll, and then we do a full narrative on the property. What's going on? What's happening with our renovations? Where is it at? Where's our delinquency at? What's our occupancy at? Just what's going on real live, as if we're having this conversation, what's going on the ground. And we provide that to our investors quarterly, because I want you to know what's going on. You should also be able to talk to somebody who has a clue about that investment. Anybody that's our investors on this call, if you call me, I'm going to call you back. If I can't pick you right up, and you can ask me anything you want, I'll tell you exactly what's going on. And I think that's important, right? I think you should expect thoughtful, timely responses. For those of you on the last call, it's only been a month, I think less than a month. So I have not done anything to update this slide. This basically tells you where we're at as a firm today. To date, we've made $130 million worth of investments. We've raised approximately $34 million over our lifetime. We currently manage about 240 investors. Last year, we distributed just under $700,000 to our investors. And this year, our goal is to distribute $1.25 million out to our investors. And we own or manage right now about 1,750 units. So my goal is to make that distribution goal double and triple over time. So hopefully maybe some or all of you can be a part of that. All right, I want to give you a little bit of visibility into what some of our deals have looked like. What you see here on the screen, Coachman Club Apartments in Clearwater, Florida. And I'm just going to show you the last 3 deals that we turned full cycle. You can see them all on the Veravest page. I just happened to pick the last 3. We bought that deal for just under $6 million. sold it about 2.5 years later for a little over 8 million. And if those of you have heard me talk before, this business is about adding value for us. And the way to add value in multifamily is by creating more cash flow. So in that deal, we moved rent from about $7.85 a month to $11.25 a month. Created a lot of new cash flow for our investors and then for the next guy. That meant that our investors level annual return on investment was 30%. That's annual, not total, annualized. And so if you invested 100 grand in that deal, you got back about 175,000 bucks. Super proud of that deal. This deal is a deal we did in Jacksonville. We sold this coming out of the pandemic. You would have thought that would have been a terrible time to sell, but this deal was doing really well. And we bought it for about $7.5 million bucks. It took a lot of equity to do that deal. We assumed the loan and we had to raise the money for our improvements as well, because on a loan assumption, it was a CMBS loan. So we had no ability to finance any of the improvements. We had to do it with equity. We sold it about 3.5 years later for a little over 13 million bucks. There we moved rent from 750 to 9.25. Our investors' annual return on that deal was 22% annual return. So here, there again, if you put in 100, 3.5 years later, you got back about 177,000 bucks. This particular deal, if you go to our YouTube channel, KRI Partners, this is called the Jacksonville Turnaround Story. I take you through the deal, what it looked like when we bought it with real true before, during, and after pictures. I thought it was kind of interesting how we did it. It's about 20 minutes. It's not too long. It's narrated by me. But if you're interested in exactly how we make money, this picture that you see on the screen, this is not what this pool and whole pool area and amenity section looked like when we started. I can guarantee you that. It looked nothing like this. And then the last deal I'll talk about is probably the most recent deal that we sold, Whispering Oaks in a small city just northeast of Orlando called Orange City. Probably have no clue where that is. Townhome style property. I love townhomes. In fact, we have one now in our portfolio. We bought it for just under 5 million, sold it for 8 million. 2 years later, we moved rents for a little under 700 to about 850. So annual return to our investors there was 36%. We were able to turn that thing quickly and really get amazing returns. We're really proud of that deal. If you invested 100,000 bucks, you got 172 back about 2 years later. Actually, it was 2 years and 1 month later is how long it took us to turn that deal. Our last fund, we deployed about 16.5 million bucks, 84 units in Tallahassee, a little under 8 million. That property continues to do well. This is probably a little light now because I didn't include the most recent month, but we've increased income by just under 30,000 a month in probably 14 or 15 months, something like that. So incredible revenue growth there. 234 units in Bradenton, a little over $41 million. We're continuing to beat our rent projections there. And there's so much demand in that city. Our leasing people can't even keep up. So super excited about the way that turnaround is going. 55 units in Daytona, a little over 8 million bucks. We continue to do really well there as well. We're beating our rent projections in that deal. As I said before, last quarter we distributed about 300,000 bucks, and we do intend to distribute another 300,000 bucks in our fund this year with all of our deals combined. And by the way, that office right there you're looking at, that's the Tallahassee deal. That's the crossing at 2600 leasing office. So pretty good. I just love the residential feel of this property. All right, current fund, and then we'll get to some real sticky stuff on the banks and everything else, but we'll keep it light here for another minute. So the fund that we're raising right now, our target return when we look at deals is an annual return of 15%. Some of that return is going to be a preferred return through cash flow. So basically in our deals, you get your preferred return, you get your capital back, and then basically it's an 80-20 split after that. So you can see we're paid last. One of the benefits of being in the fund is that if we need more money to do a deal like the Bradenton deal on the last fund, we needed some extra money. We just didn't have enough money left in the fund. So we did a side raise, and everybody in the fund got right of first refusal on that side raise. And usually we're able to do it at the exact same terms that you're in the fund. Can't guarantee that. It depends on the deal, but usually that's how it works out. Minimum commitment to the fund is $100,000, and it is open to accredited investors. We plan to hold, and you saw from my examples, we plan to hold deals for like 3 to 5 years. We make it so that if we have to hold longer, we can, because I don't like selling with a gun to my head. That's just never good in this business. But we always intend to go in, add our value, do our thing, and then sell and return the money to you. That's always our goal, so that we can then do it again. So you're assured that you actually did, in fact, make money on that property. And there's nothing more fun than sending you guys back big checks, let me tell you. Our target markets, basically Sunbelt growth markets. That's generally where we target. We don't like non-growth markets anymore. Okay. So Howard, you have a good question. So on the split, the 80-20 split, you get 80%, I get 20. I wish it was the other way around, but no, it's the investors. Absolutely. Yeah, that would be wrong if it was the other way around, because I don't think that would be fair. I want, our goal here is to make you a lot of money. And if we make you a lot of money, we're going to do okay too. Our fee structure is a 1% acquisition disposition fee on each deal and a 1.5% asset management fee. I set the fees low on purpose. I'm not here for the fees. It just takes me a lot of time, energy, and money to do what we do. And I have to hire good people. And I just can't, if I'm going to get paid truly last in the whole fund, I can't fund it all myself. So that's the fee structure. I think if you compare it to our competitors, I think you'll find that we're probably the lowest, or definitely in the low range. Michael, I see your question here. Do you ever 1031 into your properties? So here's I wish we could do 1031. It technically is possible to do it, but as a practical matter, you have to distribute each asset out to every single partner. Every single partner has to have an undivided interest, and then they all have to sign on a deed, and it just doesn't work. So it doesn't work. So we can't do 1031s into and out or out of, but here's what we do instead. So when we buy, we're going to do a cost seg study, and we're going to accelerate as much depreciation as we can. Then when we sell, a lot of that income, because we're holding it for 3 to 5 years, turns it into capital gains income. And then hopefully you can reinvest. And that hopefully, if you did reinvest, we're going to hopefully bring in another deal that'll hopefully generate as much accelerated and bonus depreciation to offset a great deal of that gain for you. So that's kind of how that works. It's not a 1031, but I do my best to try to defer as much tax as I can for you. But that's a really good question. One thing I don't think I've seen it here, but what a lot of people don't realize, Michael, is that you can use an IRA to do this. You just have to transfer your funds to what's called a self-directed IRA account, and we can tell you who to go to do that. It's a third party; it has nothing to do with us, but there's special rules that if you follow them, you can put your IRA money into these deals. And I love it when people do that, because it kind of matches up the term, right? Real estate is generally speaking long term, and IRAs are generally speaking long term as well. So there's a really good match there, and I love seeing people use IRAs for that. Let's see, John, you got another. So is ROI inclusive of distributions? It is, yes, sir. You have distributions prior to sale, right? Yes, sir. Wait a minute, you're going too fast for me here, guys. Hold on. So the way our deals generally work is we're going to distribute cash flow quarterly. My goal is to distribute annually a total of 6%, 1.5% each quarter. And then when we sell, that's when the big payday is. When you think about a value add business model, we're here to add value. And so most of the return is going to be at the end. The cash flow is nice, but you're really not doing these deals for that. You're really doing these deals for the upside at the end. And that's what we focus on. Let's see, DJ, what you got here? When you use an IRA, you are not able to take advantage of depreciation, correct? So you do. So we allocate depreciation out to all of our investors pro rata based on their capital, everybody's capital in the deal. And I put my own capital in the deal as well, just so you know. So I get a little bit of the depreciation too. I don't get more than my fair share. That's important. Now, to say that you don't get the advantage of depreciation, you're right. You don't get to take those if it generates tax losses. You're not going to be able to take those tax losses and offset regular income on them. I would encourage you to talk to a CPA because I'm, no longer practicing, so I really can't give you tax advice. But generally speaking, everything that happens inside the IRA is inside the IRA, and so if you have losses there, they would probably just sit there and wait till there's gain, and it would offset. Which again, it's the tax benefits here in this situation. They're really just icing on the cake. What I want people to focus on here is the economic objective that we have, and that is to make money. And then the tax benefits are just icing on the cake. But most people have a lot of money sitting in IRAs and 401ks and all of that, and it's a great way to get it out of the stock market and away from some of that volatility. Good question, DJ. I hope I answered your question. All right. So why do we love? So we do a fund model, right? Most of you know there's syndicators and then there's fund managers. We're a fund. We're raising a fund. So syndicators, let me just make sure you understand the difference. When you're a syndicator, you go out, you find the deal, you lock it up, and then you go out and raise the money. That's what a syndicator does. That's the way most people start raising money outside of their immediate friends and family. We've done that. We've done it for a while. The deals that I showed you were all the three that we turned. Those were all syndications. So we can do it. The problem is when you're in a really competitive market like Florida or other growth markets, you're standing next to all the other syndicators trying to figure out how to convince the broker to give you the deal. And I thought, you know what? I've got years and years of private equity experience. I've seen how it works in the private equity world. Let's flip this model like it should be. Let's go raise the money. Then we come to the market. We raise the money in advance, we get the commitments in advance, then we go out and we find the deals. So when we raise the fund, we go to the brokers and we go to sellers, say, hey guys, we've already raised the money. All that equity raise risk is off the table with us. You know that we're going to close because we already have the money. You don't have to gamble and hope and pray that we can raise the money. So that's why we reverted to the fund model. I will tell you, it's been incredibly successful. The first deal that you saw in Tallahassee, nobody saw it on the market. It came right to us because why? That broker knew that we could do the deal and we could close it and it would be hassle-free for him. The second and third deal, we weren't even the highest bidders. Why did they pick us? Because of certainty of close. That is so important in this business. And having the funds already raised. Yeah, let's do that. Already raised gets it done and gives us a massive, massive buying advantage. So the first 3 points I think I just talked about. Something that most people don't realize when you make a commitment to our fund, the day you commit, you're not writing me a check. You're not going to write me a check until I call the capital that I need to do that particular deal. So the good thing is you can keep your funds invested until I call the capital. You don't give me the money, let it sit in a bank account doing nothing and hope that I can find a deal quickly, right? You keep the funds invested into whatever you want. Another benefit of a fund is you get some diversification, right? Our goal is to put several assets inside a fund. The last fund, we put 3 assets. So those people in fund 1, they have a deal in Tallahassee, they have a deal in Daytona, they have a deal in Bradenton, all incredibly different markets and incredibly different property types. So they get a lot of good diversification there. Of course, lower transaction costs if you're only out raising money one time. I mean, it just stands to reason. Your legal costs are going to be lower. A lot of that stuff will be cheaper. That benefit accrues right to you as the investor. And then finally, in our fund model, and I think I have already alluded to this, you get all your money back for the entire fund. So if the fund raises a total of, I don't know, let's say $15 million, and we deploy all of that, when I sell assets, you get the full $15 million back as the group of investors. And I have to make sure I've paid the preferred return. And only at the end do we get paid. And I think that's really, really important for people to know, because remember, I told you one of my rules is that we get paid last, and we definitely get paid last. All right, let me take a little drink here. Since our last update, man, John, you're welcome. How do I know when to sell? And if vacancy rises or economic dumps, how does that affect portfolio investors? Okay, so let me answer your question, John. So thank you for that overview. Yep. How do I know when to sell? Well, here's our plan. Our plan is to go in, add value, leave some for the next guy, right? So we're constantly evaluating the market. How much more can we raise value based on what our business plan is? And we need to leave some for the next guy. And the reason is we got to give them a reason to buy the asset from us. So we have to leave some for him or her. And that's when we decide to sell. If vacancy rises, or I think you meant the economy tanks. So yeah, let's talk about both of those things. First of all, in our business, we're vertically integrated. That means we manage our own stuff. That's really, really important to me. And the reason that's important to me is that we've been doing this for 25 years. We have learned an enormous amount about how to run properties efficiently, how to make sure that vacancy doesn't get out of control. So in our world, every single person throughout our entire organization, if you walk up to any one of them and say, what's the most important thing at Ken's Properties? They're going to tell you it's vacancy. Occupancy is always number one in our business. So we will do whatever it takes to make sure we stay full. If that means we drop rents, we would do that, right? We don't have to do that right now, but if we had to stay full, we're going to do it. And the reason we do that is because when you're full in our business, everything else in our P&L falls in line, right? The maintenance guys are working less hard. You're paying leasing people less, everything. You're advertising less. You can be tougher on delinquencies. Absolutely everything falls in line. Now let's talk about the economy, because there's a lot packed into that question there. So our business model, and I'll show you here in a minute, but our business model is super deliberate. Everything about what we do is very deliberate. We buy only in growth areas, and we only buy in good neighborhoods, right? We don't go to the top of the market and buy the A+ stuff, because that can oftentimes be affected by new construction and new inventory come into a market. We don't go to the bottom of the market either. The reason we don't do that is because the moment we have an economic problem, who loses their jobs first? It's the people at the bottom. Unfortunately, it sucks for them, but it's just the way it is. They tend to be laid off first. The hospitality people, the restaurant people, all the people like that. We like to stay in the middle. And that's why we do that, because it insulates us as much as possible. The other reason, the primary reason I do multifamily is because if you just think about it, I can figure out how to kind of make office really struggle. I can figure out how to make self-storage struggle. I can figure out how to make retail struggle. I can't figure out how to make multifamily go away. If I have a world where nobody needs a place to live, my friends, the last thing I'm worried about is money, because that means we got really, really big problems. And so our business model is so deliberate, trying to protect against and mitigate all of these risks. So John, you have some really, really good questions. Let's see, your economic doubts. How does that affect portfolio investors? Okay, I think I got you covered there. All right, this is going to get a little bit technical. Hopefully that's okay. There's just a lot going on, and a lot of people don't understand it, and I'm going to try to put it, I'm going to do it from a high level, believe it or not. Even when you see all the weeds we'll get into here, it's still high level. We just had this meeting, this Real Deal webinar less than a month ago. And a lot has happened, man. We've had 3 bank failures. We have had just, I think it was yesterday, signs of similar problems in Europe. Our Credit Suisse had to be propped up. Interest rate risk volatility has just considerably increased. And clearly there is a lot more uncertainty about what the Federal Reserve is going to do next week with interest rates when they meet. I mean, literally every day this week, if you have watched the treasuries, the interest rates, the volatility has just been off the charts. This wasn't happening when we met just a month ago. So I want to tell you what happened, but I want to give you a couple of banking basics so that you just understand. And I'm going to try to keep it up here, I promise. First of all, banks have to hold reserves in order to meet their cash needs, right? They can't lend out every penny that they have, because you might walk into the branch tomorrow and say, hey, I need my $1 million back. And they have to have cash to do that. So they have to hold reserves. They invest some of those reserves. They invest them in a lot of things. In this case, I'm just going to talk about U.S. Treasuries and mortgage-backed securities, right? Relatively safe investments that give them a return on the money that they have to keep on hand. Sometimes they may need some cash, more than what they actually have in their little vaults. to meet depositors' withdrawals, right? And that's normally not a big deal because they just sell some securities and it really doesn't have much of an impact on their profits because rates generally don't move much. And so the value of those investments isn't going to change much. So normally it's really transparent. This goes on every day. None of us even knows it happens, but trust me, it does. Now, I'm gonna get a little technical here, but I want you to understand how this thing works if you're interested. If not, just tune me out for the next minute or so. All right, I want to talk about how bonds work because this is what actually got SVB and a couple other folks into some trouble. So imagine if the interest rates for a particular bond is 4%, and you want to buy a bond that basically is like that bond that pays 4% interest. So if you've got 100 grand to spend, you say, hey, you know what? I got 100 grand. I'm willing to accept 4% in exchange to own this security. So that's easy. You pay 100 grand for that bond. But now let's pretend like interest rates rose, right? Sound familiar? Interest rates did in fact rise. Well, what if it just went up from 4% to 5% on that type of bond? Now the world's a little different. And so now the people that would buy that bond, they're like, you know what? I'm not willing to accept 4% anymore. I want 5. All right. Well, guess what? That $100,000 bond that's already out in the market, it already pays a 4% interest, right? It already pays $4,000 a year. They can't change that. That's set. But you have this person that wants 5%. So the only way for them to get 5% is if they pay less for that bond. So now that bond, that's set in stone that it's going to pay $4,000 a year. In order for them to get a 5% return, they have to pay less for the bond. In my example, this is an extreme example. This is not real. It's just meant to illustrate how bonds work. In order for somebody to get that 5% interest rate on that $100,000 bond, they're only going to be willing to pay $80,000 for that bond. So if they paid $80,000 for that bond, and that earned 4%, that gives them a 5% return, right? The person gets what they want. Here's the problem. That bond that originally was worth 100 grand is now worth only 80 because the market says, dude, I don't want 4% anymore. I want 5. Why do I want 5? Because I could go somewhere else and get just as much. So now you have a $20,000 loss, right? Now that's a bit extreme. I only did it this way because I want you to understand what happens to bonds. So let's talk about what happened in the banking world. So let's see, John, you're right. As interest rates go up, the price of the bonds go down. That's exactly right. So I did a little extreme example. There's a lot of other factors that go into valuing bonds. I just wanted to illustrate. Interest rate goes up, price goes down in order to make sure that everybody gets what they want. Remember in our last meeting, we talked about interest rates went from 0.08% to about 4.5% in about a year. That's like crazy increase. That's not a 1% increase. That's like 450% increase. The banks didn't protect, some banks didn't protect themselves properly. There's ways that they can hedge against interest rate risk. I'm not going to talk about all those things because it's way too much. But what happened was, if banks are only paying 2%, but you can go buy a US Treasury that pays 5%, guess what you're going to do? You're going to pull your money out of the bank and you're going to go buy treasuries. Why? Because you want 5%. You don't want 1% or 2% or whatever the bank was offering. So what happens is people start withdrawing their money out of the bank. But here's what happened. They pulled out so much money out of this one bank that the bank ran out of cash. They literally ran out of cash because they all went in and they said, look, we're talking about billions of dollars all at one time. In fact, in one day, they withdrew $42 billion out of one bank for lots of reasons. So the bank ran out of cash. They tried to raise equity. They couldn't. So what did they have to do? They had to sell these securities. When they sold these securities, those securities weren't worth what they were when they bought them. So they had to recognize a huge loss. In the case of SVB, I think they lost just under $2 billion on that security sale. Well, when the people that had deposits in that bank said, oh my God, this bank just took a $2 billion loss, it needed cash, they all got nervous, and literally it was an old-fashioned bank run. Although it was just done on their phones and their computers, they pulled out $40 billion in one day. Bank ran out of money. There was nothing they could do about it. And the FDIC came in and took over. And literally within 48 hours, a bank died. Then the next day, another bank. Same thing happened. The FDIC had to take that bank over as well. Does that make sense to everybody? Are we cool with that? All right. I know I'm oversimplifying the problem, but I want you to understand what happened. So now, why are rates so volatile? Well, after our last Real Deal webinar, when I told you things were calming down, there was a lot more stability. It was great. I really enjoyed that because now we could do deals. Literally, I think we got out the webinar and rates just exploded. What happened was we got a couple pieces of inflation data that said, inflation is not going down as much as they thought. The market really believed now that the Fed wasn't going to raise just a quarter point. They were going to raise 50 basis points or maybe even more. So the market overreacted like it usually does. And so now rates went up, right? Chairman Powell, before all these banking problems, we even went before Congress and said, you know what? Inflation seems to be kind of stickier than we thought. We might have to raise rates more than what we thought. So now rates went up. And I'm talking about 80 basis points, almost a full percent in a couple of weeks. I mean, it's ridiculous how fast it moved. Those increased rates caused the banking system to kind of break. There were other factors that were involved. There's no question about that. There were other factors that are involved. Is that better? Sorry about the audio, Maurice. The banking system broke in part because rates went up and they went up very quickly. Now, yeah, was it management's fault in some of these banks? Yes, but in part, none of this would have happened if we didn't have this massive rate increase for sure. So now, because of all these bank failures, the many people believe that the bank. Okay, good. Thanks, Maurice. They believe that the Fed may not raise rates as much. You can see, I mean, literally, this is a knee-jerk reaction almost daily that's going on. And what we're seeing now is the interest rate world is responding to every little piece of data it gets because the market views every little piece of data it gets in the extreme. It's just the way, it's just the place that we're in right now. So what matters? What's next? Look, opinions are all over the map. Nobody knows. In fact, in the last call, I brought you some information from ITR Economics, a firm that we follow. I didn't even bother to do that. The reason I didn't do that is because there's so much going on. I don't think any of their projections can really help them. Can you explain how Yep, I sure will. How correlated? Yep, I will absolutely do that. Alex, give me just a minute. So nobody knows what's next. There's just opinions are all over the market, all over the map. There's no question that it seems like there's a pretty good chance markets will be volatile for a while. And I say markets, I mean interest rate markets. The Fed is now faced with kind of a dilemma. They either stay laser focused on inflation and no matter what, stay on their mission of beating down inflation, or they focus on stabilizing the financial system and take a break on these interest rates. Yep, DJ, I'm with you 100%. So now we'll see. Next week is another Fed meeting. I mean, you can make arguments both ways. We don't know. The Fed is definitely in a precarious position because nobody wants to break the banking system. That is certainly not a good idea. But they also don't like inflation. So we'll see. I have nobody has a clue where they're going to fall, where they're going to shake out. I don't even think they know at this point. So all of these things, all this volatility, all this stress and fear is definitely going to impact decision-making by banks, companies, consumers, everybody. Don't be surprised if you don't see people going into defense mode, right? So consumers will slow down their spending. Companies might start to hoard a little more cash than they did otherwise. What does that do? That slows down the economy, right? Kind of helping the Feds, if you think about it, because that's what they've been trying to do. All right. So, you know what, DJ? It's like you're, or Alex, you're leading my presentation perfectly. So back to my promise. Why do higher cap rates and interest rates continue to be good for you as an investor? So when cap rates go up, that means the price of the assets go down, right? Because you require a higher return for that same amount of cash flow. It generally will push more people into the renter pool. The reason that happens, because interest rates go up, what happens? They can't afford to buy the house that they wanted to buy before. So, but they still need a place to live. That doesn't go away. So they either are a homeowner or they're a renter. Those are your two choices as a human being. So it tends to push more people into the renter pool. We operate in super high demand growth areas. And so we already have this massive demand supply imbalance. Well, this just makes it even worse, right? It gives us even better pricing power. So it is likely that we're able to continue to move rents, even though which allows us to offset with more cash flow some of the price depression that you get because interest rates are higher. So it kind of all balances out. So you've got cap rates pushing prices down, the value of the assets down a little bit. You got renters or rents going up, which offsets a good part of that, if not all of it, depending on the market you're in, which is why I absolutely love growth markets and I absolutely hate non-growth markets, because I want my demand to exceed supply, because when I can do that, it just helps me raise rents, which is always our goal. This higher cap rate environment and interest rate environment will cause some sellers to be distressed. Now, it sucks if you're one of those people that owns and you're stressed and you can't make, your debt. We'll talk about this in a second, but your debt payments are getting harder to make. But as a buyer is a good thing, because now you have distressed sellers, and people always like to buy from distressed sellers. Howard, let's read what you said here. Higher interest rate means the cost of capital to finance a deal goes up. Yep, that's what forces cap rates up. Yep, because two parties in the deal, and at least one of them wants more return than they did before. Ayana, won't there be an impact on employment and create a reduction in state tenants? I don't know what state tenants means, but will there be yeah, so there could be an effect on employment. Absolutely, there could be. So when you think about the economy stable, oh, thank you. Yeah, sorry about that. So yeah, no worries at all. We like multifamily because the least affected real estate asset class in a downturn is multifamily, because you still need a place to live. Now, we do get some demand consolidation with kids moving back in with parents, boyfriend, girlfriend, people moving in together, roommates moving in together. We get a little bit of consolidation. But remember, the backdrop of all of this for us is we're already in a situation where our demand far exceeds our supply. That's one of the reasons that I'm so hell-bent on making sure we stay in growth markets, because even if we have a downturn, right, if we have a major demand supply imbalance, all right, so maybe it's not so major, but it's still a demand supply imbalance in my favor, and that's my goal. So I try to do everything I can to mitigate this. Howard, your question, after I buy a deal, how do I add value? So there's two ways. We either make physical improvements or management improvements most of the time. John, hold on, I'll get to you. Most of the time, we do both, right? So we do the homework up front when we underwrite the deal. And Max will tell you, we do very thorough rent studies. We know exactly where our property fits in its competitive environment now, and we know what it's going to look like when we're done renovating it or doing whatever it is that we're going to do to make it a nicer place to live. And so we believe that on the day we close, we should be able to get our higher rents that we've projected. I don't rely and hope and pray for inflation and all that stuff. We don't do that. We just know going in, we know, and our goal is somewhere $200 to $300 an upside at least in rents. And so that's how we add value. We increase cash flow. When you increase cash flow, we're going to impact the value of the property. So when you go to that YouTube video, the Jacksonville turnaround story, it does a pretty good job of showing you what kind of physical improvements we do. It's very deliberate about what we do and how we do it. So good question. John, do I provide a K1? Yes, we do. You get a K1. Is Florida? Yeah, just Florida. Right now we have deals in Florida. We are trying to go beyond Florida. We're just really picky about our deals. Is Florida tax return required for non-residents? One of the wonderful reasons people love to live in Florida is there's no personal income tax. So no, the answer to your question, Howard got it for you. I'm telling you, if you're a small business owner, when you think about it, right, moving from New York to Florida, and you've got a profitable business, it's massive difference in your tax situation because you don't pay state income tax and you don't pay city income tax in Florida. Do I have to remove it? So yeah, Brian, that's a really good question. Sometimes, so here's what we do. We want to make sure that our rent increases. We treat people, these are human beings we're talking about, right? That's really important. So what we do typically is when a lease comes up for renewal, we'll take, if the rent is $300 below market, we'll take half of that the first year. And we'll explain to them, look, guys, you're way below market. If you had to go find another place to live, there's no way you could get a place for what you're paying right now. I don't want to take it all in 1 year. I want to work with you a little bit. We'll take half of it in year 1 and we'll get the second half in year 2. Some people will move because of that. That's okay. When we turn that unit, we then rent it at the full market price. We get the full $300 if that's our upside, and it's painless to anybody. They don't even know it, right? So usually we don't need to incent people to move in Florida. Florida is generally a transient area. We generally turn 40 to 45% of the units every year. So usually it's not hard for us to move our rent roll. So that's a really good question. What's really important here is this. I try to remember these are people. And so, we don't go in and if you're $800 below market, well, we might have a conversation with you about that. That's quite a bit of money. But we try to make sure that we just take their personal situation into account, because the reality of it is these are people's homes we're dealing with. All right, deal flow. I said one of the 4 things I promised to talk about. Deal flow is up, like a lot. Poor Max is working like a dog underwriting deals. What I think sellers are trying to do, and talking with the brokers, they tell me that the sellers are trying to get their problem solved before it's too late. Say they have a rate cap that's expiring in 18 months. Well, they don't want to wait until they literally have the gun to their head and they have to sell, because in order to put a new rate cap in place like their lender would require, they have to come up with $300,000 or some crazy, or $3 million or whatever it is, right? I mean, rate caps are extremely expensive. And rate caps just serve to protect the lender against increasing interest rates, right? It's an interest rate hedge that the lender forces the borrower to buy. So a lot of sellers are saying, hey man, let's get out ahead of this. Let's get our property sold before the fire sales begin, because they think that's the right thing to do. So that's the first reason deal flow is up. The question is, will they meet the market and sell? I don't know. I mean, a lot of what we're seeing, there's a pretty good buyer-seller expectation gap. I'm seeing a couple more deals that it's getting closer. So we'll see. What we do is we try to go in at what it's really worth. And we're here. We want to buy your property. We love it to death. It's an awesome place. We have a great business plan. We'll make sure we close for you, but I can't close at 30% over what it's worth, right? So we just got to let that seller kind of come to grips with the fact that it's really not worth what he wants it to be, and see how it goes. Will someone come in maybe and overpay? Yeah, they might, but that's part of what I get paid for, and that is to make good decisions about it. Are there any hints to be able to identify has a rate cap? Oh, absolutely. Yeah, I mean, it's not hard to know what kind of loan is on a property. We use Yardi Matrix as a way. We have a national license. It's very, very, very expensive, but any deal over 50 units, we pull it up. We know exactly who bought it, who sold it, when they bought it, when they sold it, how much they paid, and what kind of loan is on it, how much is the loan, and what are the terms of that loan. So yeah, we absolutely. It's a mortgage. It's filed and it's public record, and these information services, that's what they do. They literally go find this information and charge me a lot of money to get access to that information, but it's really, really important. So we call this whole process that we're going through with them price discovery. You bet, Maurice. And so when the sellers are ready to sell, we're going to be there, right? And that's why we're raising this fund right now, because we have to be ready to strike. What really happens, and Max will tell you, I got the call about a day and a half ago, I think it was. Max can remind me if that's different. About a day and a half ago, about a deal. I don't even want to go into where it is yet. So the broker said, hey, I'm about to bring this thing out. It's a good deal. It's a big, huge seller. I want you to have a good look at it. We've got it fully underwritten, and we're trying to decide whether or not I need to go down and look at it. If we do, we'll put an LOI in it immediately. And so, from initial point of contact to hopefully going under LOI could be as short as 3 days. That's kind of how our business works. because that's what brokers want. They want quick, they want certainty. And if they work with us, they know they get it and they know we can close because we have the fund behind them. All right. Did I already talk about this higher cap rate? Yeah, I sure did. Let's go. Yep, we talked about that. All right, distributions. So some sponsors, okay, is your buy model new financing or assumption, loan to value on new financing? Jay, that's a really good question. So it could be all of the above. It could be new financing. It could be an assumption. It just depends on the seller situation. Loan to value. Right now, most loans are limited by debt coverage, right? So you got to cover your debt 125% or 130 or 135, depending on the deal and the lender. So our loan to values tend to be in the 60s range. We don't lever things up to 80% or anything. I just don't like that kind of leverage. So we stay low enough leverage that, again, I'm trying to mitigate risk here. And so we're generally around 60, 65%, maybe up getting close to 70, but it's usually in the 60s. Good question, Jay. All right, so let's talk about distributions, because many of you, if you're in other people's deals, may have gotten the notice that, hey guys, we're just suspending distributions for now. And I just want to help you understand why. I'm not going to talk about any particular sponsor, but generally speaking, what happens is some sponsors have variable rate loans in place. And that's okay if you have some protection, right? You have some what's called a rate cap or some other kind of interest rate hedge in place to protect you against those higher rates. So if you have I call it a naked variable rate loan, interest expenses literally going up and up and up and up and up. And if you think about a $10 million loan, what a 1% movement in rates costs you, I think it's $100,000 a year. Somebody check my math, but I think that's right. So you can imagine a 3%, 4%, you can see cash flow just evaporating in minutes. So when sponsors have that situation, they have to suspend distributions because they don't have any money left. It's going all to the bank. Some sponsors they do have lenders that are requiring them to escrow money. So they have a rate cap that maybe it expires in 12 months. And they say, hey, Mr. Borrower, are you planning to stay with us? Okay. We know you're going to have to buy a rate cap. We're not going to trust that you'll have enough money in 12 months to buy that rate cap. So we're going to ask you to start putting money aside right now to buy that rate cap. So that takes money away that they could have otherwise distributed to you. So that some sponsors are finding themselves in that situation. Some sponsors are actually really in a pinch. They just can't pay their debt service because rates have gone up so much, and they're doing cash calls to try to keep it under support, right? So what you see me doing here is going down the list of bullet points where you can see a seller getting under more and more stress, which is why we're ready to buy, because these people need to be helped. The properties may or may not be distressed at all. It's just the debt that causes the seller to be distressed. I will tell you that on our deals, we'll talk about this in a second, but we have good rate protection and our markets are strong. So we do plan to continue distributions. Our deals are cash flowing and protected, and I'm super thrilled about that. It's just part of the risk averse way that we do business. And we try to just manage that risk all the time. All right. I talked about distributions. All right. Should you invest now? Look, I think now is a great time to invest. It's just because imagine this, if you have a great business plan, you stay disciplined, you buy and you don't overpay, and you believe you're going to make money now. Imagine if rates actually did go down. I mean, it just is ridiculous amount of extra money that you didn't even plan on getting. So I prefer to buy when rates are higher, because then I know, presumably rates aren't going to go up another 6-7%. I don't think that's going to happen. I don't know. I'll still protect myself against it happening, but I have a feeling that right now rates are probably getting pretty close to the top, but I'm still going to protect myself in case they're not. What's really important that people do now is follow those 4 rules that I talked about when vetting sponsors, right? That's why I talked about this on this call, because now more than ever, you got to stay disciplined. You got to make sure you're investing with people that know what they're doing. The risks that are out there, they don't even know. Michael, yeah, I think we'll try to send out the slides. Yeah, that's a good question. Stay disciplined when you're underwriting. That's really, really important. Don't reach for these deals right now. And whatever you do, I see people doing this every day. Please don't get FOMO. It's called fear of missing out. Don't do that because it causes you to reach. It causes you to lose your discipline. You make mistakes. You buy stuff. You overpay, and then you find yourself in a bad situation. And just that's what's really important about investing now. It's really important all the time, but it's really important now. All right. Finally, the real deal. This is real on the ground KRI intel. I heard somebody say this a couple days ago. Business plan. I know that business plan execution is critical to success. It just makes sense. If you're going to have a business, executing that business model is really important. Most people are saying that this is the year of the operator, right? And it's why we've always self-managed. It's probably why we probably always will, because we can be extremely efficient and really tighten things down if we needed to, should things turn against us. I'm proud to report that right now, all of our properties continue to be at 95% or higher occupancy. Delinquencies continue to be low. Rents continue to remain strong. We are not retracing anywhere still. That I'm really excited about that. And we have no concessions. Concessions means, hey, we'll give you a free month if you move in. We don't have that. Those are called concessions, and we're not offering that. Howard, worst case, 2008 redux, price of properties go down. How do you handle that? Well, here's the thing with real estate. Time is on your side. Hold on, Ken, I'll get to you. Time is on your side in the real estate world. Most of the time, if you just have enough time, people run into trouble in the real estate world when their rates move against them, things like that happen that force them to sell. We're setting up our properties. Remember, I told you in the beginning, we try to hold for 3 to 5 years, but if I have to hold 8 or 9, I can. And that's important. I can wait out these problems, right? If you bought in 2007, you went through the crash, and we did we went through this process. We went through the crash and we just held on. The world comes back to normal. Things recover. People still need a place to live. That's not going to change. That's how we handle that, right? We really batten down the hatches. We really become super efficient. We're working on that every single day. And that's how we handle it. Now, I will tell you, remember, I was there in 2008. So I've been through that experience. It's not a lot of fun, but you do what you got to do, right? When you're in business. Yeah, what percentage increase are you factoring in for the rapid rise of insurance? I can't currently get a quote from my insurance agent for the renewals that happen in June. Yeah, so Brian, I don't know if you're in Florida, what state you're in. If you could tell me that would be helpful. But insurance is rough. Florida, yeah, you're getting abused. So it is rough. Most insurance companies, so you want to try to get renewed before the hurricane season. That's just kind of what you want to do. They will delay as long as they can to get you your quotes. Right now, I'm being told that it's somewhere between 14 and 30 days, 15 to 30 days in advance of your renewal is the best they'll go. They will not give you a quote today for a June renewal. They just will not do it because there's too much that can happen between now and then in their mind, right? They just have no interest in that. So let's see, in our Tallahassee deal, we had a minor, have we renewed yet? No, we have not renewed yet in Tallahassee. We just went through our Daytona renewal. That renewal was 19%. I know you're like, what? Yes, it was only 19%. It was in Daytona, and no, the property did not flood. So we had no losses from any of the hurricanes, by the way. And our Bradenton property, we're looking at a June renewal as well. So I don't have renewals on that yet. But we're expecting, 30, 40%. I mean, we renewed, we set up that insurance in mid-22 already. So it was already through the roof. And so, we'll continue to manage that. So if I get away with 50% increase in Bradenton, I'll be happy. So that's hopefully an answer to your question. Brian, how many years are your loan terms? Or can you ask that question? I hear you, Brian. When I got 19 in Daytona, I went out and did my happy dance. How many years are my loan terms? So they're generally 5 years. We're protected 3 years in Tallahassee. We're starting the process of setting up a refi so that we can lock in our rates and be comfortable. We could lock in at today's rates and be just fine. I just want to make sure that we're safe if things do get ugly. So all of our other deals were protected out 5 years. In Daytona, I think that deal actually renews for another 5-year term at our option. It'll adjust the rate, but we have another 5-year term there if we want it. So we have a number of years before we have to deal with anything significant on the loan side. All right, debt. Well, I just talked about that, right? I just told you we might refinance one. I doubt if we'll refinance the other. It changes. What would be perfect is if I can get a lot of my third parties done on a deal, I might run a refinance and just kind of let it hang there. And when I get some volatile situation like 2 days ago and rates plummet 45, 50 basis points, I just jump in and lock, right? So that's probably the little game we'll play for a little while. We'll see how that works out. I have a feeling the next time we have this meeting, I'll have a completely different story to tell you because God only knows what's going to happen between now and then. Observations. I told you this is the year of the operator. This is the reason we self-manage. I told you that. I think now more than ever, it's obvious that investing with experienced firms has never been more important. When things are great, everybody loses sight of that. It's times like this that it always comes back to, yeah, I'm glad that, we have the experience we do. I told you our business model is really, really very deliberate. This is it right here. I just want to keep reminding everybody that we buy apartment communities. There's a reason we buy apartments in growing areas. I talked about why we do that. In good neighborhoods, that is absolutely a requirement. That with physical and management improvements, we can be made to much more valuable. And we do that by raising rents, renting to better quality tenants, and significantly improve the cash flow of the asset. I love that business plan. Our business plan will probably, in 20 years, it'll probably still be exactly the same. Current fund terms, just wanted to throw it up here on the screen. Should you have interest in learning more about this fund, I think we're going to do extremely well in this fund. Of course, I always do. It's my fund. Hit the QR code if you have interest. That's going to ask you to just give me your name and email and all that stuff, and then you get access to. You'll see the complete track record verified. You'll see testimony. You'll see all kinds of useful and give you access to the PPM and everything else. All right. So in order to get started, just call us, right? Somehow get on the phone, call us. You can set up, once you click on the QR code, you can get to my email or my calendar and book a call directly with me or Max or Sherry or someone in our office, and we'll get you headed in the right direction. All right, Max, how many questions have I missed?
Don't believe any, though we did have a few people messaging me directly, so I can read these off if you're ready for them.
Yeah, absolutely. Let's roll.
Alrighty. So if interest rates stay high and inflation stays high, how will that affect both entry and exit from multifamily?
If interest rates stay high and what's the other one?
And inflation stays high?
Yeah, if interest and inflation stays high, how will that affect entry and exit? Well, we know how it's going to affect entry. And remember the part of my business plan that I said I'm going to increase cash flow, not just a little, but our goal is to increase it a lot. The reason is I need more cash flow to offset any cap rate expansion that I get. That's my goal. That's why I don't go for deals with $50 of upside, right? That's not going to help me if things go against me. So I protect myself against the rates. I do the best job I can there, and I make sure my business model makes it so I can move rents, move income, move cash a lot, right? So if you think about just the way the cycles of the real estate world works, I'm not banking on this, but I just want to point this out. Insurance has probably never been harder to achieve in Florida. Brian talked about that in his comments. Well, insurance always cycles. It just always has. So for a while, it was $400 a door. Now it's $1,400 a door, some ridiculous number like that. What'll happen is all the people that are not in Florida will say, oh my God, I can go to Florida and I can get $1,400 a door for insurance. New entrants will come into the market and drive down. So now we have more people providing insurance. That will turn the rates down. Today, it doesn't feel like that'll happen, but trust me, it's absolutely going to happen. because it does every time. It just, we don't know when that'll happen. So now if I buy when insurance rates are really high, I like that because presumably they'll go down. I'm not banking on it, but it could, right? That'll only help me. Same thing with inflation, same thing with interest rates, same thing with cap rates. If I can buy at the worst possible time when things are quote unquote ugly and all the people that don't know what they're doing and are inexperienced or too scared to jump in, see, that puts me in the perfect scenario to be a buyer. And as long as the things that I hold, I've properly protected myself against that. Remember, I went through 2008. I know what it feels like to have a massive credit crunch. And it's baked into people like, Ken, man, you're so conservative. I'm like, no, that's okay. Guess what? I'm okay right now because I'm conservative, right? I'm not freaking out because I didn't, I took risks that I shouldn't have taken and things like that. So I hope that helps.
Yeah, we got one more if you're ready for it.
Absolutely. Hit it.
So this person is asking who we use for rehab. So when we make changes to the properties, we're using subcontractors that are in-house, or who are we using?
Yeah, all the above. So here's how we do it. If it's exterior improvements, let's say it's roofs, let's say it's asphalt, let's say it's, major things like that, we use subcontractors. We don't use GCs, but we use subs, right? Because I don't have a staff of roofers. I don't have guys that do asphalt and all the trucks and all that crap. I don't have all that. So we do outsource that to subs. We do not hire GCs to handle these projects for us. So that's on big exterior common area type improvements. We're marseting our pool. We'll bring in the pool company to do stuff like that. Now in the units, it's a different story because these are renovations in my world. In unit terms, they're almost interchangeable. So when we go in to do a unit, let's say we're going to upgrade it, we're going to have the flooring company go in and do the floors because they're fast at it and they know how to do it. It'll take my maintenance guys forever to do that. We have painters come in and paint. They're outsourced. It's because they could do it far cheaper than far faster than my guys could ever do it. And almost everybody in this business outsources that stuff. If we're spraying tubs or doing things like that, we will outsource that to companies that specialize in that because that is very specialized. Otherwise, changing out plumbing fixtures, light fixtures, appliances, doors, slab doors, hardware, blinds, all that stuff, our maintenance guys do. So in the units, it's a combination of those things. And why do we do it that way? Because I can't find a cheaper way to do it. It's just the best and most inexpensive way to do that. So that was a good question. And that's what we do. And we're heavily involved. What we don't do is hire a GC, say, here, go spend $3 million. Go give me back a perfect profit. We just don't do that. That's not the efficient way to do it. You can go broke doing that. So good questions. Any others? I know Ken had his hand up earlier and he pulled it down. Ken, are you good? I don't know if he's still here even. Yeah, I guess he's good. Any other questions, guys? Hopefully this has been helpful. Hopefully, if you guys have questions offline, you want to talk, just shoot us an email. Max is M. Thomas. I'm KGEE at KRIproperties.com. He's also KRIproperties.com. Love to hear from you, but I really appreciate you coming. We will send out, give us a few days here on the replay because we'll cut out all the garbage stuff and get you a nice tight replay so that you can have access to it if you want. We will likely put this one up on our YouTube channel. If you haven't been to our YouTube channel, I would encourage you to go there, KRI Partners. It's obviously free. I believe you could probably become a brain surgeon on YouTube if you want, because people just share. We're the same. There's so much of our content. We've got over 100 videos there. I do all of them myself. Sorry to say. But I want people to learn as much as they can about this business because I really enjoy teaching it. So feel free to go to that YouTube channel, subscribe. That lets people know that our content is at least worth listening to. So, all right, I think we're good. Thank you, guys. Have a wonderful evening, and hopefully we'll see you next month, if not sooner.